If you've ever sold a stock for a loss only to buy it back a few days later, you may have just triggered one of the IRS's most confusing tax rules, the wash sale. It can quietly disallow your losses, increase your tax bill, and cause massive headaches when you file. So in this video, I'm going to break down exactly what a wash sale is, how it works, how to find them on your tax forms, and whether or not you should even bother trying to avoid them at all with real examples that you can actually follow. Let's get into it. What is the definition of a wash sale? A wash sale occurs when you sell a security for a loss and buy a substantially identical one within 30 days before or after the sale. You just gotta love vague IRS terms. Substantially identical. This can include options, ETFs, or shares of the same company. While somewhat vague, the intent behind this rule really is simple. The IRS wants to limit traders from claiming a fake loss for tax purposes while essentially holding the same position. So let's say you buy 100 shares of Apple at $200 per share. That's $20,000. You sell at $180 per share, which is a $2,000 loss, but then you buy back those 100 shares less than 30 days later. That's where you trigger a wash sale. That $2,000 loss is now disallowed and added to your cost basis. So why does this matter in the first place? Well, this could actually make substantial swings in your taxable gains or losses for a given year because you now can't deduct those losses in the current year. The loss is actually deferred. It's added to the cost basis of the new shares, which pushes the loss to a further sale. So if your new cost basis becomes $182 instead of $180, so back to the Apple example, if your new cost basis is actually being reported as $182, even though you bought at $180, when you sell it later, that loss is eventually recognized. But only when you stop triggering wash sales. So you can kind of keep piling these things up over time. So how do you find wash sale information? It's found on your form at 1099B that you're going to get from your broker. So it's whether it's Robinhood, whether it's Webull, Schwab, whatever. And it's usually going to be labeled under the wash sale disallowed column. So in this example right here, you're going to see $112,000 in wash sale loss disallowed. Some brokers will also provide downloadable CSV files, which make it a lot easier to find individual wash sales. And if you want to keep track of these things over time, you can use a trade journaling software like TradeZella, which I'll link down below. I think there's a discount code if you're interested. And you can use that to tag different trades and organize yourself. So you're kind of keeping tabs as the year goes on. So you're not going to be super surprised come tax time. Now, before I dive into a full tax liability example calculation, can you avoid these things? Well, yes, if you wait 31 days after you sell, let's say Apple, to rebuy it, then yeah, you can avoid having to deal with the wash sale. Maybe you want to buy a different ticker that's in a similar sector. You want to get tech exposure in a similar way. That's not the same stock, or that's not like a leveraged version of Apple. You could do that too. But this brings me down the rabbit hole of, well, if I'm a day trader or I'm a swing trader and I only swing trade, let's say Apple, or I mostly swing trade a handful of stocks, it's very possible that I'll be in and out of positions all the time, pretty much triggering wash sales left and right all year long. And it's not the end of the world because eventually you'll get to realize that loss down the road once you stop essentially triggering wash sales on that specific asset. But if you're a long-term investor, it's a lot easier to kind of manage this because that's why at the end of the year, people call it tax loss harvesting, where that last month or so of the year, you'll see a lot of people sell the stocks or sell the assets that haven't done that well. This way they can realize that loss for the year, and then they'll come back in January after about 31 days has passed, and they're going to rebuy that same asset. Essentially taking the loss now, making it easier on them to come tax time, and then rebuying next year. But what if you keep deferring? What if you have a strategy, let's say you use even an automation, you use a platform like Alpha Insider that'll take trading strategies and automate them, and you have a strategy that just trades Tesla and just keeps trading Tesla all the time. So you keep triggering these wash sales and you never have a 31-day window where you don't reopen a position on the same thing. So let's say that you had $37,000 in short-term realized gains and you had $53,000 in short-term realized losses. Your net P&L is going to be down $16,000 for the year. But what if every single loss happened within 30 days of each other? That means all that $53,000 is going to be classified as wash sale loss disallowed on your 1099B. So what the IRS sees is that you made $37,000 and you lost zero because that's all going to be deferred until you finally stop triggering wash sales on Tesla. The IRS says your taxable income is now $37,000. But what really happened is you lost $16,000. Now, those $53,000 in losses that you've realized over the course of the year, they just get deferred and keep rolling into the cost basis of your current position on Tesla. So if you ended the year holding a position in Tesla, you can think of it as those shares now have a massively inflated cost basis. So let's say that your final open position on Tesla is 500 shares at $200 per share. That's $100,000 of market value. Because of the $53,000 in disallowed losses, your new cost basis actually becomes $100,000 plus the $53,000 to be $153,000. So the next time you sell those 500 shares, that $53,000 is going to reduce your future taxable gain or increase your loss, assuming now you eventually don't trigger another wash sale. So how you fix it for the next year is you finally sell out of your Tesla position. You wait at least 31 days, then you rebuy it. That deferred loss now becomes realized for the new tax year. That means you get to report that $53,000 loss on next year's taxes. You can use it to offset future gains, or you can use it to offset a maximum of $3,000 per year against your other income if you have no gains. And you can keep eating back into those losses up to $3,000 per year until you finally have gains again. So where this really hurts you is if you're in the 24% tax bracket, based on our prior example, you're now going to owe approximately $9,000 in federal taxes on money that you don't even have anymore, which is unfortunately the painful reality of the wash sale rule. So like I said before, you can stop trading this specific ticker if, again, you're following it and you're realizing, hey, I've been tracking with, let's say, TradeZella, and I'm like, yo, I'm accumulating some decent losses here. That's obviously not great because you're losing money, but I don't want to screw myself and have to pay more taxes than I need to come tax time because I might be tight on cash. So rotate, change out of the ticker completely for the month of December and trade something else, or just take that month off. Now, there's also an election that you can make. It's called the 475F mark-to-market election. If you're a qualified trader, and don't take it specifically for me as tax advice, speak to someone who is a professional in this case. But if you have this election, you're able to treat all gains and losses as ordinary business income and losses, which means wash sales will no longer apply. Now, I believe this must be done by April 15th of the current tax year, and it is a permanent accounting shift. You also can consider trading a different asset class like futures. Now, futures completely different when it comes tax time. There's different tax rules, no PDT, and all of your gains and losses are essentially marked in this mark-to-market fashion. So the wash sale doesn't screw you completely. It just defers your losses to the next tax year. If you are someone who potentially could have an issue with this, the most important takeaway is that you are aware of it and you're doing the proper things in order to mitigate the downside. It's really just a timing thing, and over time, things should even out. So if you have any questions, leave them in the comment section down below. Happy to answer them. I am not a tax professional, unfortunately, or fortunately. I don't know if I would want to be honest with you, but that is what I know when it comes to the wash sale rule. If that helped you guys out, consider leaving a like and subscribing to the channel. I'll see you guys in the next one. Peace.